entity documents and the sophistication of the use of entities in this industry, I mean, it's a night and day difference now versus even 10 years ago.
I highly advocate and suggest, even though it does take more time to have the appropriate valuation based on your economics, so you're setting the liability tied to your cash flows, not somebody else's.
When it comes to entity documents, there are so many different things you can build in. We really need to consider what are your objectives for your business, not just this year or in 2 years, but also in 5 or 10 years.
The biggest mistake or the miss is one, either thinking I'm not big enough or I don't have enough to sell, or just a matter of I don't know how or I just don't have the time to. When, I mean, we can tackle this in no time. You have the tools, it's just knowing how to use them.
I can't tell you the number of transactions where buyer and seller show up, say, this is the easiest deal ever. And by the end of it, I'm like, wow, this is one of the longest, most involved deals I've ever done.
The misconception is when you go to find a buyer that is just super simple. Maybe you're getting folks who are coming to you from like a broker dealer. As a result, they're biased in terms of who they're putting forward. That's exactly what you don't want.
All right, welcome back to another episode of SRG's Exchange, where I get the pleasure today, David Crow, host of today's session, or host is probably the wrong term for it. I'll kick us off and get the conversation started, but I'm joined with all of our various project managers to unpack a topic that is very apropos for the Q1 of the year. We talk about mergers, acquisitions, what's happening out there right now with these deals, trends for 2026. Parker and I just spent an inordinate amount of time going through and looking at all the deal data from last year, doing our big annual press release, finishing up our infographic. So anyway, this is very top of mind for all of us because at the end of the day, we all sort of play our various roles in putting these deals together. So to get us started on our conversation here with the group today, lots of experts and people with different perspectives. I'll tee it up with one, probably lob it over to you first, Parker. But Kristen, I know you live this reality. Todd, you've seen it. I mean, we've all had a front row seat to this stuff from our different perspectives. When does somebody involve an M&A team like SRG, right? It's tricky because I get the idea from a client's perspective. If you're a buyer or a seller, right, we're trying to figure out sort of, do we have a deal or don't we? And I know sometimes people end up delivering something that is maybe a little too far along on your plate, Parker, where then you end up having to sometimes take a few steps backwards. So if you had your druthers, if you had to give a piece of advice to advisors, clients listening, when would they get somebody like us involved in a perfect world?
Yep, I think that's a perfect place to start here. And certainly something that I have seen multiple times, as you mentioned, where a lot of alignment has happened on the front end between the two parties. But certainly there could have been some benefit from an outside perspective to help support the strategy and design of the transaction. So I would say, to your point, have some general alignment. Understand that there's a fit between buyer and seller, and you're not coming from completely opposite ends of the spectrum as to what it is that you're interested in accomplishing. But beyond that, I would really advise bringing in outside resources at that point to help you craft the transaction. As you mentioned, we've seen things that have been agreed to that, one, they just don't even make sense or work from a tax perspective or a legal perspective or from an external financing perspective. So certainly we want to help guide our clients in appropriately addressing each of those components. Also, we've seen things where folks have started into the transaction already. Well, I've been telling the clients about this. I may have even exchanged payments already. We don't have a contract, but it's fine. We all get along. It's going to work out well. I've legitimately seen good relationships where suddenly the buyer has more leverage on seller because certain actions have already taken place, and that has affected negotiation. So that's where I would really advise bringing in some external support, or even just having initial conversations with a firm like ours to start to understand what you do know and what you may not know or perhaps could benefit from.
Yeah, and I would echo that, Parker. I think that we've all seen people who have come. I don't know that there's too early. I think if I were to err on one side, it would be earlier rather than later. We've seen many that have come in that they've gone really far down a rabbit hole that we have to unravel. Parker, to your point, because of tax consequences of the ideas that they have, or because of legal concepts, or if there's a broker dealer involved, or regulatory issues. I would also say that one of the things that I think is important always is education. And the more that you can listen to webinars, podcasts like these, any of our information that you can get your hands on, take a look at, because as you engage us, that will align us and it'll help us and you and your buyer and your seller to go through the process a lot more smoothly.
Yeah, and I just want to echo a couple of finer points there as well. For instance, the depth of alignment amongst buyer and seller before engaging an outside party can matter. For instance, if buyer and seller show up and say, "Oh yeah, we've agreed on a price already." Well, if I'm a neutral non-advocate and I go and I look to challenge the price, I'm either going to negatively affect the buyer or the seller. And if you've told me that you've already agreed on the price, well, then you're not seeking consulting from me in that respect. Now, one person may be paying more or less than they should be based on that fact. And so that's another component that we can help you address. The other factor I'll mention in timing is I agree with Todd. It's never too early. We've absolutely had clients that show up and say, "Oh, the deal's happening in a year or 2 years." Now, there are very much specific nuances that have to be accounted for in these future deal scenarios, but we can help you with an options agreement or a binding obligation to purchase or sell at a given point in time. The challenge does come very often when folks show up thinking they need 6 or 8 weeks to get a deal done, most especially if you've got external financing. But even without that, a lot of times the sellers worked in the business their entire career. It's a very emotional process to align on the structure and the details. And not only that, the contracts, and potentially have your external legal counsels weigh in and agree on the outcome. That does not happen in 6 weeks or 8 weeks. It takes longer than that. So I'd say even if you've made good progress and you do have general alignment or experience, certainly, look 3 months, 4 months at least out to the transaction date.
Yeah, and just one other detail on that, going down that rabbit hole too far. One of the things that we've seen, and Dave and Kristen, we saw this in the last few weeks. One thing I would definitely be wary of is signing agreements before you get to us. That happens, I won't say
Yeah.
regularly, but it happens. And
Yep.
we get a look at the agreement and we say, you have some hurdles to even get to work with us because you've bound yourself to some things that maybe you knew or maybe you didn't know. And that just makes it that much more difficult for us to be able to help you and for you to be able to get what you want.
Yeah. But you had mentioned Todd, or maybe it was Parker, on doing your homework, whether it's podcasts like this, whether it's white papers, right? There's a lot of educational content out there, but I've also seen cases where folks only talk to their peers, right? Like I know somebody, they've done a couple of deals. I talked to them about how their deals worked and it worked great for them. So I'm going to bring that to bear on my deal. And maybe if you had the same fact pattern or set of issues or risk tolerance of the buyer and seller, that would actually work. I have definitely seen instances where, again, I don't get to sit in the seat that Parker does as much anymore, but there's a deal that came across my desk that I worked on, and man, it felt like you were pounding a square block into a round hole. But we worked it out, right? We figured out all the nuances, we got it done. And lo and behold, 6 months later, the same stupid deal shows up again. We're like, my goodness, I got to do it again. And sure enough, guess what happened? They were talking to other folks. They happened to be at an independent broker dealer. They have, regional meetings. They talked and they're doing the same deal. And while the deal wasn't a perfect fit for the last one, but we made it work, it was an even worse fit for this one. And it really sucks when the buyer and seller feel like you're making progress. You've got some momentum, right? We've got an agreement. And then we have to sort of be the wet blanket as nicely as we can, right? But to give them some context, well, I understand what you're doing and why you're doing it, but here's some other alternatives that most folks in your situation, they wouldn't be doing it. And here's why. And they agree, right? But then we got to sort of erase half the whiteboard and go back a few steps. And that just sucks. Deal momentum is super important in these deals. So as we think about the overall process, I'm going to lob one over to you, Kristen, because you sort of get the start to finish process in seller advocacy, right? Where Parker, they come to you where like they've met, we've got a meeting of the minds, at least knowing that we want to buy and I want to sell. Now help us. Kristen, you start even earlier in that timeline, so you can give a broader perspective, I think, on the process from finding your buyer to closing that deal, right? And my premise for this question is, and you know where I'm going with it or who I'm talking about, there was an prospective client I talked to not too long ago that had come to us and said, "Hey, why would I use you, right? We're already 80% of the way done with this thing. I want to sort of justify to myself why I'd pay this fee." Well, then you sort of find out where this client was at in the process and you realize we're not even actually in the first inning yet. let alone 80% of the way complete, but they just lack context for what all is involved in this process. So, anyway, there's a question buried in there. What's the process look like?
I think so often people think that they're 80% of the way done because they think that they've found a buyer, any living and breathing organism, essentially. And then they've talked in these broad strokes of terms, right? Like, oh, I'll give you 10 times. 10 times on what is not decided. What that number actually looks like is not decided. The terms are not decided. And then, you start to peel the onion back and it's like, okay, well, 10 times on earnings after all of these add backs, which really, really brings the net income to a much smaller number when you look at it. And then it's one third, one third, one third, right? One third up front, maybe in cash, maybe not. One third in equity, and then one third in a payout, usually based on some sort of revenue goals or metrics being met. In reality, though, I think that our process takes a slightly different approach, particularly on the advocacy side. And first, it's really just understanding what you're looking for. Are you looking for price? Are you looking for terms? Are you looking for fit? And then diving further into what does that actually mean for you specifically? And then we go and we find buyers who meet those criteria. Maybe that's when we go to a PE firm specifically. If it's terms, maybe look for firms who can meet maybe a high price or dollar figure, but also can come back it up with term. And then similarly, perhaps it's fit, right? And so maybe they want someone who's with Schwab or SEI or Fidelity. And so we'll go look for folks who are within those particular custodial platforms or who maybe is willing to add those custodial platforms. I think that the misconception is that when you go to find a buyer, that it's just super simple. Usually you're getting those buyers from folks maybe who are coming to you with ulterior motives. Maybe you're getting folks who are coming to you from like a broker dealer or something. And as a result of that, they're biased in terms of who they're putting forward to you, right? They're neutral. I had a seller who was working with us, and from my perspective, it was pretty ironic because he was told to actually not work with us by a buyer and rather to have, and this buyer was encouraging him to work with another broker who was helping facilitate the transaction. And I'm like, that's exactly what you don't want, right? You really
Right.
don't want someone who's super buy side oriented when you're trying to have an advocate on your team. So, needless to say, finding a buyer is definitely step one. Once you understand what you're looking for and where your priorities are aligned, and then you go into offers, which more so outline all of the different processes, which is really where Parker's team starts to kick in and outline what that deal structure looks like.
Well, and you touched on it there. It seems like there's a shift away from focus on the fit and now more of a focus on, I would say, price, terms, and then fit. And it used to be the opposite to me, right? Like you would see people, like I remember, I mean, feels like years ago now, right? But Kristen, there would be people who would then pass on the highest offer for the second highest offer, right? Because that was the perfect fit for their clients. And they knew long term retention would be higher as a result, which probably means more value in reality. So maybe value is still on that top of that list, but fit was always the top priority, right? And so retention rates have always been really, really strong. Now it seems like the conversations solely revolve around the value in most cases. I don't know. I don't know if it's a good or bad thing, right? But it definitely seems like it's a shift.
Yeah, I would definitely echo more of the same. I think that value is definitely, or purchase price rather, is definitely the primary driver of these transactions. What can I get? Even though everyone tells me like, oh, I don't need this to retire. But then it's
Right.
definitely what am I going to
Yeah.
get from a purchase price? And then next would be terms. But again, some of these firms who are pushing forward the offers, they do it in a way that honestly a lot of sellers don't quite understand all of the details and what that actually means to them. And so, it is really important to understand the details. But I also think a lot of firms or a lot of sellers are also wanting to stay on longer. So sell, take a little bit of chips off the table and then stay and, continue to build their practice as part of that final payment structure.
Which is probably a good pivot to come to you, Ryan. So there is a maybe not a constant challenge, but definitely an occasional challenge between the concept of the price I get and the valuation you delivered, right? And those things on the surface, right? If you value my business at $10 million, that should be what I sell for. But I definitely see instances where they're coming back and wondering, like, well, is SRG's valuation right? Because I'm getting 12 million for my practice and you said I'm worth 10. So do you really understand where the market is, right? How would you respond to something like that? Because they're not the same thing, right?
Oh man, I get it on both ends. uh, Starting from the sales phone call to the delivery of the actual valuation results. On the front end, when people come in wanting a valuation, and to your point earlier about less about appropriate fit, and it's which valuation is going to give me the highest number. So that's what they're looking for. And need to understand, more importantly, is that value is based on cash flows. So there are two commonly accepted approaches for valuing a financial service business. And without going into the weeds, there is a market approach and an income approach. They often deliver different values. You don't reconcile the two in this industry, specifically because they have different assumptions of cash flow. So people often want to lean towards having the market approach to have their practice valued when they're looking to do an internal succession plan or transition ownership internally. So the issue with using those market comps is the cash flows in market transactions. So think business to business sale represent a different level of cash flows. Those values, those marketplace multiples are based on buyer economics. More specifically, when you're selling your financial services practice to another financial advisory firm, usually the acquirer is going to be at a minimum the same size, if not larger than your practice. So they're going to have similar operating costs, operating structures. They're going to have their CRM. They're going to have all of their technology stack. They're going to have staffing. They're going to have their own professional services. So there's just a redundant or a reduction overlap in operating costs between the two
Right.
firms. So as a result, buyers are going to build those synergies into the offers, as a result, leading to a higher value because there's going to be more cash flows afforded to them because they already have the cost structure in place. Now, when you're looking to sell internally, that's where an income approach becomes most important, because an income approach is going to value the business as a going concern, meaning we're going to look specifically at the revenues, your opportunities for growth, the average age of your client demographics, how much market growth are you actually going to participate in, what is your operational efficiencies, and how does that translate to cash flows? Because when you sell stock, we need to not base value on external buyer economics. We have to look at what your economics are. So, short answer for your question.
That is the short answer, actually. I've heard you get the long one.
Yeah, matter of fact, to his point being the short answer, I'll just translate that back to the transaction advisory focus for today as well. When you are obtaining a valuation for the purpose of affecting a transaction, that's step one. That's phase one, right? A lot of times we see folks say, oh, yeah, I had a valuation done. Well, one, was it a certified objective third party valuation, or was it more of a back of the napkin type of valuation? Are you using that word just because you did a calculation amongst each of you as to an average multiple and you're calling that a valuation? So, one, the form of valuation matters, the methodology of valuation matters, but not only are those things important, but also the interpretation of the valuation as it relates to your specific transaction circumstances. So, the risk profile of the transaction between buyer and seller, the payment terms, whether those are, far askewed from the assumptions in the valuation output, and then just other factors relating to the transaction, even balance sheet equity when we're talking about equity acquisitions of entities, corporations, LLCs, as opposed to pure book sales, asset sales. And lastly, the timing of the report matters as well. Oh, yeah, we have a valuation from 2 years ago. Okay, great. Well, if you want to have a future based transaction where you are orienting pricing around a prior dated valuation, that can be done, but you need to do that work proactively, not show up 2 years later and say, oh, we decided a few years back we were going to do this. Well, there are more formal ways to accomplish that. And a lot of times folks say, well, it's going to be 100% cash. Well, not every buyer automatically has the ability to produce 100% cash. So if we're going to structure a deal ahead of time, we need to have contingent payment terms and other mechanisms built in.
Yeah. And, Parker, you brought up a good point there around timing of valuation. Most valuations for any sort of lending transaction typically have a 1 year expiration date on it from the bank's perspective. So if you've had your valuation done within the last year, that'll work for lending purposes. For most deals, however, and for lending, I would recommend having your valuation done within 6 months. If anything materially
Yeah.
happens between when the valuation is done within either of those timeframes, 1 year or 6 months, you can easily pull the multiple from the valuation and apply that to the appropriate benefit stream, whether it's recurring revenue, EBITDA, or discretionary earnings at the time closer to the transaction if you want to adjust for any sort of revenue growth or decline.
I'd also say the size of the firm matters in terms of evaluating a practice. Sometimes I get these sellers who have $1 million, let's say, and their expenses are very low. But then at the end of the day, they're like, oh, well, I should be on the earnings based trajectory approach. So million or 900,000 times 10, I'm looking at boatload of money. And it's like, well, not every structure is going to get 10 times, number one, and not every entity is going to be based off of an earnings based multiple. Like it may not apply in those instances. Yes, you are buying the cash flow, but you're just really buying the clients and the revenue, not necessarily the business structure and entity and all of that. So I think there's a couple of reasons why the valuation is so crucial to helping you understand not only what your value or potential future purchase price is, but what are your options and what do those options look like? And are you comfortable with the options that are being presented to you?
If I got $1 million a year in fees, for example, and I sell that, most of the time I don't really care what my expenses are, right? If Ryan buys that, he's got his own $2 million shop. He's just going to pick up my revenue, my assets, my clients, and put them into his infrastructure. Like he said earlier, it's a synergistic sale. But add a zero to that equation. Now I got 10 million a year in revenue. Well, now you need the whole kit and caboodle, right? But there are still times I know where we have the wrong recommendation or the client selects the wrong valuation approach. $1 million client example, but they're selling to their two internal junior advisors. Well, now we're back to caring about what the expenses are. So it is size matters, but also use case matters too, right, Ryan?
Yes, I'm in the camp that size doesn't matter. So,
Yeah. Okay. You would be.
um, looking at the transaction data, and that's the world that I live in when we're doing valuations. And a common question that I get is, what are the break points when if I hit a certain size, when does my valuation jump? And there isn't necessarily a strong correlation to at certain size ranges or certain break points that value jumps. But what does matter is how practices are commonly priced. So when I'm looking in the transaction data, I'm looking at several different pricing multiples. I'm looking at gross revenue. I'm looking at net revenue. I'm looking at recurring, non-recurring, looking at AUM, earnings, EBITDA or EBOC, earnings before owner compensation. And so I have these options of pricing multiples. So I then have to take that information and look statistically what is most accurate for valuing a business. We know in valuing a house, it's not the square foot of the property that matters, it's the square foot of the house. So that's your pricing metric when you're valuing a house, is what is the average price per square foot. We can adjust up or down from there based on the quality of the house. When we're valuing a business, we've got several different pricing metrics. So I have to go look at which of those is most statistically relevant for valuing a practice. Typically under the 2.5 to like 3 million is kind of the transition point where gross revenue multiples have the strongest correlation, very strong correlation. As you start getting over that point, then there's a stronger correlation to either EBOC or EBITDA comparative to gross revenue. The reason is when you're buying a smaller practice, buyers are going to place less emphasis on what your operating costs are. So again, I made the comment earlier about buyer economics. That's what matters. They're going to consider the cash flows available to them based on what their cost structure is. That's going to set their perception of value. So we're not going to value smaller practices based on their earnings. Really, from a valuation perspective, it doesn't matter. You can have 100% overhead. You could have very little overhead working out of your home. It's going to be based on buyer economics. Now, as the practice grows, we start adding systems and processes and people to the mix. There now are costs that are in place in order to continue serving the practice. The market dynamic considers those factors when you start crossing over into that $3 million in revenue threshold. That's where we start looking at the earnings multiples, and earnings multiples are different than revenue multiples because they fluctuate as you go through different growth cycles, which is a new dynamic that then comes into the valuation. So this is the one thing that trips up a lot of people because they think, well, I've invested in the business, I have the systems and processes, I have the people, I've got the size, therefore I must be worth more now. Well, no, because going through the investment process and the business, hiring those people, you start introducing a lot more moving
Expenses.
pieces, a lot more variables, a lot more expenses. So hiring immediately is going to be a hit on your P&L. That's going to decrease your expenses. It's going to decrease your margin, your earnings. Therefore, most people think that's going to have an impact on valuation. Or the inverse, what we tend to see is people try to run their staffing up to full capacity in order to have high margins. And then they come to market and I want my 10 times EBITDA. Well, unfortunately, your servicing ratios for your admin staff and your advisory staff are well above averages. You can't support the growth that you've had without making a reinvestment in the business. So EBITDA multiples will fluctuate depending on where you are in that growth cycle. You've invested in the business, you've put the appropriate people in place, strategic investments. While earnings are low, you've increased growth capacity. That means we're going to be on the higher end of the earnings multiple spectrum. You've now grown into that capacity. Your margins have expanded. Your growth capacity has decreased. You're going to be on the lower end of that spectrum. So just anchoring to EBITDA multiples without understanding where businesses are in that growth cycle means you stand a pretty big chance of under or overestimating value.
Yeah. When going back to the original premise of that question, which was way back when in our conversation on sale price versus value and valuation, it's a little different in your neck of the woods, Nicole, right? With the mergers, because you don't have that whole synergistic, right? It depends on who I sell to. How do you guys deal with valuation in mergers? 'Cause I feel like it's definitely distinctly different than the work that Parker or Kristen does in the buying and selling world. Is that there?
Definitely. It depends on really the complexity of the merger. We have sometimes a couple people that come together who bring a book of business. They might have a little bit of operations that they want to combine. Here, the process can be pretty simple. You could use a valuation as the foundation and basically just take your value and you divide it by the total value that we're bringing together. And that's your ownership percentage. So it could be as simple as that. Every once in a while, people want to still talk about, some projections. There might be something in the works, some opportunities that they have lined up that are close to come to fruition. So they want to account for that, of course. But in general, those types of mergers can be pretty simple. And then we have the other side where we have two very mature businesses with a big infrastructure. Here, the valuation is a good starting point. So, to what Parker said earlier, we might utilize that just to get a general idea, but then we still need to talk about things like, have all the expenses been normalized, or do we need to consider something else and adjust for that? Are there things on your balance sheet that will come over? So with a lot of those mergers, it's not just the assets that we're combining, it might also be the liabilities. And then how do we address that? Are there any cash flow expectations that might not line up when we actually put the numbers together? And now we need to adjust for that as well, because with a merger, hopefully we can always structure it so it's a win-win. Otherwise, people wouldn't enter into that merger. So we might have to adjust for that too. So for us, the valuation is a good starting point, just to see what are the strengths and weaknesses, what is the general idea in terms of value. And then there's still a lot of analysis necessary and negotiation after that to get to an actual ownership division.
Yeah, and I just want to jump in here and add, she did bring up a good point around value and or liabilities and debts, which I wanted to reintroduce as something that's relevant not only in mergers, but in many different deal transactions on just understanding what debt is existing. First and foremost, I don't know if anyone out there has ever bought something and then resold it. We certainly see that, right? Hey, I'm selling the business. Oh, by the way, I actually bought a portion of it. No, I actually might still have some debt outstanding on it. Okay, well, great. We need to understand what that debt is, what the characteristics of the debt are, whether or not it's transferable, whether or not this transaction would satisfy that debt in full. If so, what are the logistics of addressing that debt? There's other factors more affiliation related, such as forgivable loans, special comp arrangements, production bonuses and awards and things that are set to transfer. So we can address all of that in the deal making. And of course, it can influence price or it can influence terms or it can just influence the logistics of the transaction that need to be accounted for. So certainly something that we're adept at working through in a number of different situations, I can say.
I've got one for the group, really, but Ryan, you'll have an opinion on this because you've heard it more than probably most. There was an industry pundit expert out there with a very similar name to mine that would talk about the fact that internal succession can actually get the same value as an external deal. What say you? I mean, frankly, Ryan, you, from your perspective on valuation, Parker, you've run the cash flow on both deals and internal succession plans, right? They're two very different things, but can you legitimately get the same value on an internal sale as you can on an external sale?
Generally not. No. So there are very few firms out there that have strong growth rates that are operating significantly more efficient than the benchmark that through an income approach are going to come in with a higher value. And again, it's not the difference in the approaches, it's the difference in the cash flows that are being valued in each approach. So in an internal sale, the thought behind you're going to get more value out of this transaction is that you're going to sell little blocks of stock over time to key stakeholders in the organization. And what you're capitalizing on is the efforts of the other people on the team who are helping grow that value over time. So you're catching a little bit here. Well, now you've got multiple owners, therefore there's more focus on growth and profit margin. Their value is going to increase more rapidly. Then you're going to sell another little block. But in an internal transaction, there's other considerations than just the cash flows. There is risk and control dynamics and marketability and saleability of those stocks. So not uncommon to have conversations around minority discount, especially if the buyer in that scenario is going and taking out a bank loan for a minority interest when they don't have a seat at the table. They don't have a voice on compensation, when profit distribution is going to be made, what level of debt's going to be taken on. In an income approach, in most cases, the value is going to be less compared to that of a market approach. Then when you start layering in level of control, I'm selling a minority interest. Well, we're now going to take that 5% pro rata value of a controlling interest. Now we need to consider discounts for marketability, discounts for lack of control, because those are very real things that you can't just go sell your minority share to anybody. You can't force a sale. There usually is going to be some form of punishment for doing that because you want to distance it. You don't want to incentivize that behavior. So generally, no, that's not the case where you're not going to capture more value in a singular transaction over possibly, but again, that's assuming that the succession plan works as designed. So I would say going that route isn't, if you're focused on value and getting the most out of your practice, not the best avenue. That's really more geared towards, I want to build something that has legacy attached to it that's going to survive beyond me. I have control on my exit timing, my exit strategy, how long I'm staying in the business. And also, this is a relationship based business. I like the people that I work with. I like the people that we're serving.
And to be fair, you can sort of annuitize the business, right? On an internal deal where I sell 20% now, take some chips off the table, value grows 5 years later, I sell another 20%. But right, yeah, if we just put time value of money to the side, yes, you can definitely get the same value. But there's the time value of the money, right? And so there's lots of other reasons you might do it. But as far as like multiples go, values, it's going to be pretty tough on an internal basis to get that same value. But Parker, we just talked about multiples, right? Ad nauseum on our annual webinar. We worked on that press release. We're finishing up the infographic. Where are multiples at right now? Probably a good topic to touch on.
Yeah, absolutely. And I don't want to belabor the points, but I do want to just add quickly to the internal sale dynamic, which is we get plenty of partner to partner deal support, transaction advisory engagements. And part of that comes down to what is in the buy sell agreements. Does it address retirement or address your specific circumstance? If so, are the terms current and accurate? Beyond that, do the parties agree to that, or have they agreed that they want to do something different outside of that within the internal transactions? Again, it might seem very simple. Well, I'm going to buy X and sell that percentage. Okay, we've got bank financing lined up. Great. Well, what's the debt security parameters on that? Is the LLC guaranteeing it? Are the majority owners guaranteeing it? How does that affect the transaction? And then again, beyond that, is this a substantial partner to partner transaction, or are these minority junior partner transactions, and they look differently and they act differently? So again, components of
Yeah.
those internal sales that we are consulting on. But to get to the most relevant question that most of our audience, if they missed our recent M&A update, will certainly be interested to know is the market multiples update. So for recurring revenue in 2025, that average multiple came out to 3.26x, and that's an increase from 3.08. So I know years ago it used to be 2 times and then 2.5 times. Nowadays, a lot of folks talk about 3 times. To the earlier conversation, these are averages, right? So there's a good chance that you're going to be above or below that average. So I wouldn't rely on that for a transaction, but it is good to understand just the directionality of the market. And as we, have recently discussed, multiples have continued to trend up to a relatively sizable degree in this last year. Outside of that as well, for EBITDA multiples, which is more so the income based reference point for those internal sales or economic acquisitions, that jumped up to 9.98 from 9.2x. We don't have to go into it right now, but there's even more nuance to utilizing EBITDA or earnings multiples as there is compared to revenue multiples. Regardless, both sets of key multiples have increased in 2025.
Well, I want to real quick pull on that thread you touched on earlier, Parker, with the partner stuff, because I mean, if we're talking sort of trends with M&A and what's happening out there right now, I would be remiss if I didn't talk about one of the things that you touched on in the webinar we did, I don't know, whenever it was, a couple of weeks ago. And that was the number of internal deals taking place, like internal equity based sales. And I'm lobbing this one over to you, Fry, because I think about the work that we do now around setting up entities, and it's not setting up the entity that's like the important thing here, right? LLCs and S corps. You listeners could literally be doing that while you listen to us on your browser through your state, Secretary of the State website, or with a number of tools out there online. But I would also say the amount of time and effort that we spend on crafting new operating agreements that are designed for teams, multi generational teams, right? We've got younger advisors who are focused on pouring profits back in. You've got older advisors who want to pull profits out. The entity documents and the sophistication of the use of entities in this industry, I mean, it's a night and day difference I see on the stuff that you're talking about, Nicole, now versus even 10 years ago, right? Like, it's mind boggling in some cases, like how important occasionally revisiting this topic, like erase the whiteboard and set it up, because what got you here won't get you there.
It's definitely a theme, I think, that we have today here on the show. Parker brought it up earlier that on the deal side, it's not just about agreeing to a purchase price. There's so much more to the deal. He brought up the debt and anything else that you have to consider. And the same holds true for entity setup. We always start off with what are your objectives for your business, not just this year or in 2 years, but also in 5 or 10 years down the road. And based on that, we need to figure out what entity structure works best for you. And then to your point, David, when it comes to entity documents, there are so many different things you can build in. So we really need to consider the practice that we're dealing with. What are their plans? I deal with Julia, who's here, who deals on the equity sharing side a lot. And we talk about, clients want to set up in terms of an equity sharing plan. What are they envisioning? Are there vesting events? All of that should be woven into those entity governance documents so that they're set up well. So to your point, it takes a lot more work, and it's good to think things through, not just for the short term, but also for the long term. Because I tell you, clients don't want to dig up those entity documents on an annual basis. If they can get done in a way that they work for them for a number of years, that would be ideal. So that's the intent.
And I'm going to turn this conversation maybe into a debate, or at least get clarity on it, because I am still, believe it or not, unclear. Julia, Nicole, I've talked to you guys together and independently. If you're doing an equity sharing plan, do we set the plan up based on the entity, or do we set the entity based up on the plan and what we want to do?
We'll get our boxing gloves because it's a debate. Yeah, I mean, it really is scenario dependent or team dependent, especially I would say how they're coming to the table, whether it's working with us or someone else. But I mean, if you have something set up related to entity documents and, essentially a structure in place that might limit you initially, then obviously we want to know about that coming into an equity sharing strategy development phase, whether that be, hey, we need to redesign and rethink this because we set this up 10 years ago and don't even know what the heck we set up or remember. Other times it's we don't have anything formal because I've never needed it. So it's not a shame on you. Matter of fact, it's just I haven't needed it and I need it now. So from that perspective, I would say Nicole and I are on the same page on try to encourage you to think about where your priorities lie. When you're thinking about, okay, I need to restructure or in the first place, structure some organization around governance documents. Is my priority making sure that this ends up being an internal succession in terms of my future with business and where I want to see this go? Or do I realistically probably see just a full-on exit at some point in the future, but I want to make sure that I'm retaining key talent now for the remainder of my time with the business? Do I really want to prioritize taxes, which, we do hear that as a high priority item, but we can usually peel back the layers to knock that down a peg or two on the order of importance, not because it's not important, but we do want to think beyond some of those intricate details that we think about more frequently. But big picture, there are other items like, how do I share equity with my team? How do I get that to them? At what point do I want to share control and decision-making power or not? Is my goal to increase compensation? So maybe it isn't real equity and sharing responsibility, etc. So obviously there are a lot of considerations that you might be thinking of or haven't yet started thinking of when it comes to equity sharing, but priority and creating a prioritized list is typically step one to decide, where do we start? But a lot of times it's collaborative, to answer your question.
And I have a little bit to add there. If you ask me, the entity should just be a vehicle to accomplish your goals. It should definitely start with, what are you trying to accomplish on the equity side? Or I work with Parker's team a lot too on the deal side. What is it that you're envisioning? And then we can structure your entity accordingly and your documents accordingly. So it's really good to get an understanding of what it is that you want to do with your business, and then the entity should support that. It should be a tool that you use, a strategic tool to support all of your business goals. But you start with those business goals in the first place, whether that's on the equity sharing side or on the deal side.
I was recently talking to a client and I happened to watch the recording of this particular conversation. And it was quite funny because they were trying to do an entity. Well, they have a tax arm connected to them. And so the first question that Fry asked as part of this call was like, do you have your entity documents? And they're like, nope, we don't have it. And she's like, oh, well, you could connect to your tax accountant, probably have a copy. And they're like, well, that's us. We don't have it. And so it's like, oh gosh, like even firms that should have it all together sometimes don't have it all together. And then they're like, honestly, we just like checked boxes. Like we don't even know what was in that particular, what we've selected or opted into or out of. So needless to say, sometimes just setting up an entity, that is not the right approach. That's not the approach you should be taking. That's the approach we often get like looped into. Like, why would I pay you guys this amount of money to set up an entity? That's easy. That's not what that is a byproduct, but we really are focusing on the strategy aspect that's been reiterated today. But the second thing that was really funny with that was they're like, well, how do we make decisions about our equity unless we know our entity? How do we make, and then she's like, well, that's a great question. Like, it really depends on what you want to prioritize. And then they're like, well, how do I make decisions about my entity if I don't know about my equity? And she's like, that's part of this call. Is we're trying to help you figure out how what is your top priority? What are you trying to accomplish? What are your future goals? And then we can, weave in, but it's maybe not entity first or equity first. Oftentimes, and correct me if I'm wrong, Julia and Nicole, but oftentimes I think it's like, okay, let's do a little bit here on the entity side and then we'll pause. We'll do a little bit on the equity side. We'll pause. Maybe we go back to the entity and then we'll wrap everything up. So it's really meant to be, as both of you reiterated, a collaborative approach to help create the best strategy forward.
It is definitely dynamic, I would say. The approach, these concepts are complicated. So there's no easy solution. It requires a little bit of back and forth. I think people have to understand you have to take your time and go through a process to determine really how you want to set things up. Our goal is always to educate our clients so that you make decisions with full information. We don't know what we don't know unless we are presented with the various options that are out there. And that's the goal that we have here is making sure you understand what your options are so you can choose the right one for you. And there might be a little bit of back and forth, but ultimately it's all part of a process that is very common and should happen that way in order to get to the right solution in the end. And I remember that particular conversation and just bringing it back also to Parker, to his work. Part of the story was too that even though they were a tax firm, they didn't understand that they had an S Corp set up, but their goal was for buyers who bought a share in the business, they wanted to amortize or write off the purchase price over time.
Right.
It's not an option in an S corporation. And so this is when I work with Parker a lot. Should we restructure this business? Should we turn that into an LLC so that they have that opportunity to amortize the price?
Yeah, and that's a good segue. That's something else that you do on your end there, Nicole, is advise in some capacity around tax structure, right, of the firm, because that matters for internal succession. That matters for external sale, full sale. There are certain tax elections that can be utilized. Of course, SRG is not a tax firm. We're not tax advisors, but we know enough to be dangerous around certain strategies that are commonly useful for a number of situations that we address. Again, this could be the full sale of an enterprise. This could be partial, internal, fractional sales. Beyond that, what you've done in the past matters. Going back to my earlier comment, I had a client, I'm working with a client right now. Oh, we've been talking about the deal since middle of last year. Turns out they actually need to go through a restructure on their organization to accomplish their goals. They're put into a very tight timeline right now, looking to hit a deadline in a couple weeks here for the reorg. They also have external lending on the line, which of course is complicating matters further. So had we started this conversation middle of last year, we would have front run this consideration. We would have had all the time in the world to get the reorg done and have the closing and funding and everything lined up perfectly. And then the other thing I'll mention too, here's an example of how detailed or nuanced this can get. An LLC taxed as an S corp doesn't even have the same options available to it as a pure traditional S corp. So things like that alone, you might think, well, we're an S corp. Oh, I heard so and so do this. Well, it can actually differ based on some of these other finer details.
It's good to hear you talk about it. I mean, frankly, the whole group here, because again, going back to the topic for today, which is merger and acquisition trends, what we're seeing for 2026 based on what we have seen in the past. Usually, when we do that, the focus is on the multiples, the deal structures, the tax allocation, right? And that's always a component of our analysis and release because those are always interesting highlights. But boy, I mean, it's come on in a big way, right? Where you're seeing these solo advisors growing into silos, the silos into these ensembles, and now these super ensemble mega teams where the entity strategy matters a lot, right? To your point, Parker, it impacts the succession plan, the viability of cash flow management after taxes. It impacts your ability, Julia, to do equity sharing. So the entity is, I mean, I hate to say it because it's kind of boring, right? But entity planning, sophistication, and leveraging it has been a major change in the industry. And I would then also say equity sharing. Again, I talked about it earlier. I don't know what it was, Parker, but I think it was like almost a third of the transactions we saw last year were like internal equity-based transactions.
Yeah, exactly.
That's
Just
a
about
lot.
1 in 3.
Yeah. Right. So I think about the work that you do, Julia, where phantom equity plans, synthetic equity, whatever you want to call it, or real equity sharing plans, grants, structured purchase plans. That used to be something we've always done it, right? But we would do it for the industry's biggest firms. They had big teams and they needed this. But again, you're doing a lot more of that work now. What's a typical client look like for equity sharing at this point? And any best practices you can share?
Yeah, I mean, I would, to your point, say that the small fries are in the game as well now. So it's not just the biggest, the largest. The basis of what you need is an entity, a structure, a business of some formality and a value, which most of you listening do have a value. You might not know necessarily like a formal independent third party's analysis when it comes to value. So that's a great starting point for any conversation, as we've kind of covered already today. But you have the tools, whether you know it or not. So sometimes it's just adding a little bit of formality with a little bit of guidance and some expertise in the industry, of course, to be able to pretty quickly sift through, okay, that's not the best option here. I don't want to prioritize that. I don't see this for my team or my future, to figure out, okay, what are the best tools that the industry commonly is using? And that's what I work with most of our clients with these days is, a select few that are most commonly used that then we can peel back the layers and make them yours, make them fit for your team. So yes, a heck of a lot more common. Size does not matter, but a little bit of formality and a little bit of structure goes a long way with these types of things. So it's more about just putting in the time now to make sure that you have use of this great tool. So I would say the biggest mistake or the miss that I see around equity sharing is one, either thinking I'm not big enough or I don't have enough to sell yet, or just a matter of I don't know how and this is wildly overwhelming, or I just don't have the time to. When I mean, we can tackle this in my opinion, no time. You have the tools, again, as I mentioned, it's just knowing how to use them.
Yeah, I want to add real quick just on some of just, I don't want to say mistakes. There are a lot of people that choose to use market approaches in what I'll say are the wrong context, primarily because a market approach is a much more cost effective valuation tool. Generally requires less input, so it's easier to give information to get a result back. So, in the context of equity sharing, specifically with phantom equity, we see a lot of people that will anchor their value to benchmark values using a market approach. Now, going back to what we discussed earlier, the buyer economics are what are driving those particular values. Specifically, there are synergies baked into market multiples. So when you think about deferred compensation, you need to think about how you're valuing the company to determine that deferred compensation. When you anchor to a market approach, you need to understand what you're anchoring to. You're anchoring to buyer economics. And as a result, what you're doing is you're creating deferred compensation, which is a liability that is and should be tracked on your balance sheet. But it's not tied to your economics, it's tied to buyer economics. Now, those are real values. You could sell your practice for that. But if you do have somebody that exercises their deferred compensation right at some point in the future, you're obligated to pay out those funds. So that's where I highly advocate and suggest, even though it does take more time and it does cost slightly more money to have the appropriate valuation on your company based on your economics. So you're setting the liability tied to your cash flows, not somebody else's.
Yeah, those are all really, really relevant points. And I'll jump in here from my side just to give some of my parting thoughts as to really what I see, I would say is the best piece of advice that I can give, which is not to just assume that your deal is simple, that it's straightforward. You know a little bit about payment terms, lenders, pricing, so you're all set. I can't tell you the number of transactions that I have supported where buyer and seller show up, say, this is the easiest deal ever. And by the end of it, I'm like, wow, this is one of the longest, most involved deals I've ever done. I would absolutely say, whether that's our firm or another firm, utilize external resources, folks that do this day in, day out. I do need to go tally the number, but I must have about 500 transactions under the belt at this point. So certainly I've seen every variation of what could be considered and help just about every one of those through to a successful close. Every once in a while, we're going to get something that truly is simple, straightforward, makes sense and works, but that is the outlier. So don't just assume that's going to be the case, because it can cost you financially, it can cost you headache, it can cost you heartache. So really that's the advice that I would give. And
Parker, how many emails do you get between Christmas and New Year's for people that want to their deal before end of year?
yeah, in the year, not only for our team, but also lenders, this is the peak, the absolute peak of transaction volume. So you want to be even further ahead of the sequence there. I know I mentioned 3 to 4 months earlier, and that wasn't definitive guidance as to that's when you need to engage, not by any stretch of the imagination. Absolutely, you can and should engage earlier than that. I'm saying at the bare minimum, budget 3 to 4 months. And that's really outside of that year end time frame. So engage early. It's going to help us. It's going to help you. And especially for the year end transactions, which most deals want, which is why it's the busiest time of year, get started even earlier.
Yeah. And while I say
Right?
that
Like,
facetiously, was we get close to Q4, that's when everybody wants to get their deal done. They want to have, a fresh either 12/31 or January 1 close date. Literally everybody. So starting in August or September, if you're wanting to get your deal closed around that time frame, gives you ample runway to get through the underwriting process if lending is going to be involved, to get through due diligence if that still needs to be performed, to get your valuation updated, get your deal terms dialed in, get the contracts drafted, revised, and reviewed. There's a whole lot that goes into the process to make sure that everything is done and buttoned up. When you start waiting until end of October, we're in now into November, we've got the holidays coming up, workloads are starting to pick up, so plan ahead.
I know Ryan said August, September. I'm telling you right now, you can get started in summer and have the best time possible structuring your deal, have the least amount of stress possible, and get the best result. August, September, it works, like I said before, but that's really what I'd say is the bare minimum, especially for that year end timing.
all right, well, you've officially stole my thunder because I was going to say the exact same thing, right? Where yeah, August makes sense, right? But I feel like the happiest clients, if you're doing a sale of your business that you spent 30 years in many cases building, would be give yourself like a solid 6 months, right? Like start it in July, have your valuation done by maybe August, mid August, have serious conversations, be working with Parker's team, work through the financing because a lot of these deals are bank financed. And I mean, that adds on a month or two, and I'm being generous, assuming that things work in parallel at the same time as the deal work that you're talking to the bank. So you could be done with the whole process, have the contract signed, let's say in October, November, and have a closing date of December 31 or January 1. Those are the happiest clients because then they can spend the last part of the year talking about how we're going to execute on this transition, communicate with clients, no one's stressed. Or if you are, it's about holiday shopping and presents and not about putting the deal together. So it does take more time than you'd think. But if you look at the scope of it, right, to do a deal in 6 months for a business you spent 20 or 30 years building, it's really not that much time. Oh, anyway, I started earlier. But to land this plane, overall valuation multiples, you touched on it, Parker, they are definitely trending up. The use of the entities and equity sharing trending up in a big way. And I'll give, a real quick example. I was at a conference for Focus here like last week or the week before. And there's an advisor who came up and I mean, very successful, very large team. And had just heard our presentation, and it was kind of an in-depth, like, 400 level course on this. And we touched on entity planning a little bit. And they came up and I mean, they were kind of shitting on one of our competitors and saying, well, what you're saying makes a ton of sense. We worked for your competitor firm 10 years ago, and they didn't talk to us about any of this stuff. And I had to sort of defend them because we've been in that same situation. Well, 10 years ago, you didn't need what I just presented to you. You would have thought we were crazy or that they were crazy delivering a grossly over-engineered scenario and solution. So again, the industry is evolving. The use of these entities is evolving. You touched on the equity sharing programs and platforms. Like these are not tools for the industry's biggest firms. I mean, they are, but you can do it with one owner and one successor or one key advisor on your team and really anywhere in between. There's just been so much changing over the last couple of years in this industry as teams have gotten bigger. The stuff that you all deal with has gotten more complicated, where you were definitely having to shift from being a full-time advisor to at least part-time CEO. So I feel for you. Hopefully we can continue to bring you some helpful content through these sessions here today, through the exchange, through all of our experts. But with that, folks, I'm going to go ahead and wrap things up, land this plane safely, and give everyone back the mic. Appreciate it.